next fund. Because when you think of it, what does it look like from the point of view of the fund managers themselves? The model that's been adopted in most places around the world looks something like this. You would have a team of experienced entrepreneurs and finance people who form a venture firm. They will raise a fund. They raise the fund from a range of different investors, often people like pension funds and sovereign wealth funds who, generally speaking, don't pay tax. So they like the tax transparent nature of the venture fund. And then the fund managers have to go out and find many different opportunities to invest in. In my experience, I'm still a non-executive director of a venture fund management company. In my experience, you review hundreds of companies to shortlist just 4 or 5 every month to be reviewed by the investment committee, and you might invest in 1 or 2. So a venture fund has to do an awful lot of trawling through the companies that there are out there to find the likely successful ones. There's a lot of work involved, a lot of time involved. And even though, as a venture fund manager, you've spent a lot of time trying to decide which companies to invest in, the likelihood is that, going back to my previous example, you will probably only have maybe 2 or 3 real success stories out of 10 in your portfolio. And this impacts quite a lot on how the venture fund managers themselves get rewarded. If you're an entrepreneur, it's probably worth knowing about this because it will go a long way towards enabling you to understand what life on the other side of the table is like. You know, what is motivating your venture fund manager? There are some variations on this, but broadly speaking, the numbers hold true for most venture funds. Let's say if the venture firm manages to raise a fund of $50 or $100 million, it will have a limited life of a maximum of 10 years, which means in practice that the fund managers are only making investments in companies like yours during the first maybe 5 or 6 years of the fund of the life. And then they spend the second 5 years of the fund of the life trying to sell off the investments, because if they're still holding equity shares in companies they've invested in at the end of 10 years, unless they can get an extension from their investors, it's a bit like scoring a goal after the last whistle has blown in a football match. It doesn't count. You would have to find another way of selling on those shares. Typically, venture fund managers charge a 2% annual management fee, particularly during the investment period. And that 2% fee is there to help them pay for their property costs, to pay for their analysts, to pay for their legal fees, all the expenses you have of sorting, finding, sifting the investment opportunities and then looking after them. But the real reward to the fund manager comes if they manage to, in return to their investors, more than they received themselves in the first place. Because generally speaking, they would get a return of something like 20% of the uplift in the value of the fund. So if you've trebled the size of the fund and you started off with £100 million or $100 million fund, your payoff is quite significant. If you only just about managed to break even, then probably you've spent about 10 years of your life where all you've had to live on is the fund management fee and you won't get a profit. So that's why, if you're looking at life on the other side of the table, you know, what motivates the people who might invest in your company, this is quite a key thing for them. They are quite concerned to make sure that their fund will beat the average. And that way, they also get a financial return, as well as the recognition that goes with having achieved above average figures. I think I then need to break down in a little bit more detail 2 different types of equity finance. So far, we've been talking about institutional funds, venture capital and private equity type funds. In many countries now, I think governments have been very successful at helping to create a well-functioning venture industry. And the doings, the successes of venture funds tend to get covered quite widely in the media, not least because so often they are investing in companies which are newsworthy. It could be companies which are newsworthy for the wrong reason, companies like WeWork, where one of the very big funds, SoftBank, tried to take its investment in WeWork to an IPO at the end of last year, but it turned out to be overvalued. Or it could be that it's companies invested in by venture funds that have done very well, particularly companies at the moment that are doing things to combat the COVID pandemic. And I'll say a little bit more about what fund managers are doing about COVID in a moment. On the other hand, in the world in which I operate running an innovation centre in Cambridge, where at any given time we've got about 80 companies on site, and we're probably working with more like 300 companies across Cambridge, we couldn't function without business angels, private individuals who have substantial wealth, investing in businesses and spending a lot of their own time and energy in those businesses. And my definition of a business angel comes from work done for the British government about 12 years ago. Angels are not just people who invest their own money directly, but that really does matter. It is their own money, unlike the fund managers in a venture fund. They're investing in independent businesses. And above all, they're taking an active involvement in the management of those businesses. So it isn't just that the funding goes in, it's the energy, the business acumen, the connections, the ability to criticize a business plan, the ability to find other investors, to find customers. All that matters enormously to high growth companies. And I'd say it's one of the privileges of my job to sit on the board of several companies where business angels are the driving force behind the founders of making sure they come to the right decisions. Now, the third type of funding that is absolutely crucial for early stage companies, particularly before you've got any customers, let alone any profits, is grant funding. And what we have to be careful with the companies we work with here in the Innovation Centre is making sure that when people are applying for grants, they don't just do so because it's non-dilutive finance. In other words, it's money that isn't going to eat into your equity, but it's a grant which is targeted to help you with the specific activities that you would have wanted to undertake, even if the grant money hadn't been there already. Amongst the reasons why it's so important that the grant has to be appropriate is there's a lot of work involved in applying for grants, and that seems to be true in almost every country I've worked with. At the moment, I'm working on a project with a group of entrepreneurs and universities in Thailand, and they have exactly the same challenges that we do in the UK, that we found in France, that we found in Germany. And grants almost always come with conditions attached. Sometimes it's to do with reporting, and if you haven't reported exactly as you're supposed to, you can be penalised, you might not get some of the grant paid, you might have to pay some of the grant back and so forth. So our approach to grant funding is to say, I know what I want to do, let's see if the grant is out there that will support our plans, rather than simply going out and saying, here's an index, here's a list of grants, which ones might be appropriate to us. If you do that route, you might spend an awful lot of time doing applications and reporting, and you're not actually spending your time on the business how you wanted to in the first place. I won't have time to talk about valuation this evening, but I did just want to say a few things about when you are raising money. Often, of course, you have to raise money when you need it. But if you have the opportunity to be able to say, okay, I know I'm coming up to a really important inflection point. So for instance, I've got enough money to keep me through to the point where I managed to raise my first big contract with a well-known corporate entity. That is something that is likely to raise the value of your company in the eyes of investors, whether they are angel investors or venture capital investors. So you can go through a flat period when your company has no news to report. or you can go through an exciting growth period in terms of the perception of the value of your company when some good news has happened. And some of the best news of all is always going to be winning contracts with people who are actually prepared to pay for your contract. And as I come to wind up, I just want to say a few words about what we've seen in the past 4 months or so of the impact on the investment market of what's happened with the COVID pandemic. In the first month or two, particularly around Cambridge, where a lot of our companies are very technology based, what I was finding is that almost all investors were reserving their funding, whether they would be prepared to invest in companies that only to invest in those where they'd already got an equity stake. They weren't looking at new opportunities. What we found in the past 2 months is I think investors have relaxed. They understand the new normal a lot better. Just before I came on this call, I was looking at the database of investments made by venture funds around Cambridge in the past 2 months, and there's been a definite increase that companies are receiving funding from venture funds, even if they had no previous connection. But with the companies I work with, what I've found is that the sort of questions they get from investors tend to be, how will you still be relevant in a world after COVID? How good are you at controlling costs? Venture investors always want you to control costs, but at the moment that is one of the most important things on their lists. And are you involved in sectors which are particularly relevant to combating the COVID pandemic? And at the end of last week, one of the companies that my venture fund had invested in several years ago received investment of 26 million from external, 26 million pounds from external investors, because it has been developing a new way of delivering targeted antibiotics and delivering in a very targeted way other medicines. So suddenly it has become highly relevant in the post-COVID world. And for that reason, in this month, it has received more investment than it has received in the previous 5 years. And I think its future looks very good. And I'd just like to wrap up by saying that all I've been able to talk about in 20 minutes this evening with you, is an overview of some of the key issues that I think apply anywhere in the world. One of the things that I've been doing for a while now is working intensively with entrepreneurs. And for instance, this year, we're running several courses for the Royal Academy of Engineering here in the United Kingdom, working mainly with postdoctoral innovators, people who are taking university research to market. And we run training courses that last an entire day. Sometimes that's so exhausting we have to spread it over 2 days. And what I put up on the board for you here is the agenda that we tend to cover when we're running a full course. And that, ladies and gentlemen, is all I wanted to say for now. Our approach to really early stage businesses is to say that at the outset, you don't know exactly what the finished product's going to look like, but it's a bit like an artist working on a sculpture. You've been given a block of stone and you have to find out what the sculpture inside it is like. Now, Dr. Hanadi, I don't know whether you will be able to read any of the questions on the chat box, if there are any, or whether it be easier for us to come back and perhaps deal with questions after a short break. I'm in your hands. Thank you very much.